So you're looking to get into the BRRR strategy and you're confused, you're wondering, how do you fund these deals? Should you be doing it cash? Should you be doing it on bridging? Is it actually mortgage fraud if you do the BRRR strategy on a mortgage? What is BRRR? BRRR is the ability to buy, refurbish your property, force the value up and then refinance it based on the new value. If you want to learn more about that, this is not the video for that. Definitely check this video out to learn more about it, what I've done before. But basically, if you're going to use this, what funding do you use, and is it going to be fraud if you use a mortgage? The first thing you want to do though is smash that subscribe button, smash that like button to help the algorithms out, and let's get into how you fund your deals. And I'm going to show you straight away, debunk that myth that you can't use a mortgage, because I've done the best part of 100 deals, and the large majority of these BRRR deals have been done using a mortgage. So as I said, what I'm going to start with is going to go into using a mortgage for this, but then we're going to find out which is the best way to fund a deal. There's no one way to fund a deal. It really is a bugbear of mine when people say you have to use bridging, you have to use cash, or you have to use other people's money. What you have to do is you have to look at some of the fundamentals in a deal. So there is major fundamentals that you can ask yourself to figure out whether you're going to do a deal. So you've got to think about, what is your money supply? How much availability have you got to money? You then got to think about, what is the pipeline of deals? What is your availability to deals? And then you've got to think about, what is the percentage of profit in each of these deals? So what you want to do is think about this, like mix these questions together, will then give you the answer on what way you should be funding your deals. So if you, for example, if you've got a large amount of money, and a good pipeline of deals, the percentage of BMV, how low that percentage of BMV is, sometimes not so important, because you're replenishing a lot of money. Then you might structure the finance of this in a different way, and we'll come back to this on whether it should be mortgage, bridging, cash. And again, it just depends. If you've only got 30k, you can't fund it cash. And using OPM, other people's money, to fund deals like buy-to-lets, normal straightforward vanilla buy-to-lets, is pretty much a non-starter, because if you've got no money to put towards it, it's very rare. You can get BRRR deals where you get all your money out. The Fontaine brothers, who I've just coached, check them out online. They've just done a deal and got all their money out and some money on top. Napa, another guy that I've coached, has just got some money, 10k on top of a deal. They are out there, but they're few and far between. The reality is you're going to leave some money in a deal. I've just done a deal which we bought for 77k. I spent about 9k on it and left just over 10k in the deal. That's quite much more typical than the ones you're going to get all your money out and money on top. So if you're going to lend other people's money, you've got to think about paying them back and how you pay them back and the interest. So if you lend 100k and you give them 10%, you give them 110k. And if you're leaving 90, you've only refinancing 90k out, you've got a 20k shortfall. So the reality of using other people's money on smaller deals, if you're already in your journey, is a pretty much non-starter. I talk about this a lot in the property delta matrix. Check this video out for the property delta matrix, because I won't go into it too much here, but make sure you're in the right position. So thinking about using other people's money, then it's a very different place where you're going to be if you've got a load of money or if you've got a good supply of money. So think about this as well. You might have an inheritance and no more accessibility to more money. So for example, somebody might have, like I coached another guy and he had £250,000 in cash. He had a load of stock options that he could liquidate, and he earned best like 6 figures a year as well. So he had a good accessibility to funds. So for him, the BRRR strategy wasn't so important. It's more putting return on capital employed and building quick, because sometimes when you're just going for the BRRR as well, you've got to look at the opportunity cost trying to find these best deals. If you've got a good pipeline of money, then you want to put it into the deals, because the income, the opportunity cost of not having that income and the compounding effect will outweigh you trying to get the best deals sometimes. But let's get back to the mortgage debate and let's debunk this debate for once and for all. So can you do BRRR on a mortgage? And the answer to that is yes. There is mortgage products out there. The Mortgage Works is one company, NatWest, Kent Reliance. There's a number of companies that will give you a product called a light refurbishment mortgage. So you go over here, you buy your property on a mortgage. Let's say you buy this property for 60k. You spend 15k on your refurbishment, your legal costs, etc. You then get this done up value. Let's put this in a different way. This is the buy, refurbish, refinance. So this is where you're buying, this is where you're refurbing, and when you refinance, if the new value is 100k, and you get 75% loan to value on that, you're getting a 75k mortgage, getting all your money out, your 75k out. These are few and far between these deals, by the way, but that just gives you a simple example of that. But you can do this on a mortgage. So you put down a deposit here. Let's just say, for example, just for easy math to make my head easier, this is not exact numbers, just to round this off and make this example easy. Let's say you put a 15k deposit down, you've got 45k mortgage and 15k in it of your own money, and then you've got the 15k in it here. It means then when you refinance it the 100k, you're going to pull your deposit money and that back out. In 6 months time, you can go back, and ask for an advance based on the new value, this 100k. So you do it on a mortgage, you put your 15k in, then in 6 months time, you go for an advance, you pull your money out. A large proportion of the deals I've done has been done using this method. But I've also done, because there's like 3 major ways you're going to fund these deals. You've got mortgage, you've got cash, and you've got bridging finance. So apologies for any spelling mistakes on this. I'm a bit dyslexic. The writing and the whiteboard is designed to give you a little bit of a visual towards learning, not for a grammatical lesson. But anyway, look, you've got these major ways. So what you've got to think is, when you think of this delta matrix here, you've got to think to yourself, okay, how much available funds have I got? As I said, what sort of money have you got? What pipeline of deals you've got, and how good are the deals you're getting? Because like bridging, for example, everybody talks about bridging because, for instance, you can do a bridge and get the money back pretty like there's day one lenders out there who will lend you before the 6 month rule. So you can do a bridge, do the work within 3 months, recycle the money back out, and go again. But the thing with bridging is it's very, very expensive. So you're going to be paying, on average, on these sort of style deals, on average, you're going to add about 4 to 5k on top from this bridge into the deal, just on legal fees. Because don't forget, you've got to do 2 lots of conveyancing, like 2 lots of solicitor fees. You've got to do 2 lots of brokerage fees, 2 lots of valuations. You can do bridge to lets, but in my experience, bridge to lets is where you stay with the same company, so you don't double up on the fees, but they often give you a lower end valuation. So a little bit more cautious. Also, when you use a BRRR, like if you use a mortgage for this, they can sometimes be cautious because they've already got your business, so they're not looking to overexpose. They can be a bit more cautious on the end value. But then when you're looking at these 100k deals, let's say they are a little bit cautious on this end value with a mortgage, you've not got double fees, you've not got, the entries are a lot lower, there's a lot less flaff goes with a mortgage than it does with bridging. They want to know schedule of work, so they want to know a lot more. So let's say you do get this down valued at 5%, sometimes it evens itself out of what you're going to be in there extra with fees. And this fees wise is not lending as a percentage against the mortgage. You have to stump this money up yourself. So for me, mortgage has been my favoured way, but sometimes I've used bridges. So again, when we go back over to here and we think about our pipeline of deals, so sometimes I've had a really strong pipeline of deals and a really strong availability to money, like private funds, my own funds, compounding it, recycling cash. So then I would often use a bridge in this situation, purely because even though I'm going to leave more money in the deal, the speed to get more money back is more important than leaving more money in the deal, because I've got good accessibility to money and I've got good accessibility to pipeline of deals. I'm not so worried. I want to get some decentish deals, but I'm not so much worried about leaving this extra money in there and damaging the deal a little bit. I've done a deal, I'm doing deals cash. I've done deals, all of these methods, by the way, so I'm not against any of them. Mortgage has been my favourite for the reason I've said here. But again, if you're thinking about doing cash, you've got to think about how much money have I got available to me at that point. So think about it. Look, if you've got 30k, if you've got no money, by the way, there's a different method to this. I talked about it earlier on. Maybe check this video out with no money. But let's just say starting pot, these average properties, we'll say for easy math, you need 30k to get these properties done. So let's say the average property you're going to get is 30k. Let's say you've got 30k, you've got 60k, somebody's got 150k. What would you do with these different levels? So with 30k, most of the time I'm going to look at doing the mortgage method for that, because basically by the time you add all these bridging costs into it, really marginally into, you've got to spend a good 10k on the BRRR refurbishment to make the banks believe why it's worth more money. Even you buy it cash now, even if you buy it on bridging, they want to see why you've uplifted and forced that value up. So if you've only got 30k, mortgage for me, most cases is the way forward. If you've got 60k, you might think a blend of the mortgage, or you might think of also a bridge, because you've got a little bit more money to absorb these deals. But again, a bridge will be dependent on how good that deal is. So if you've got a really fantastic deal, you want to bridge it, you want to get in and out of it really quickly, can work that way sometimes. But then if you've got 150k pot, I've done this many a times with a lot of my clients as well. So with 150k pot, you've got an opportunity cost. The likelihood, even though you could potentially buy 5 properties with your 30k, so this could get you 5 times properties. What you've got to think about is, am I going to find, unless you buy a portfolio, what's the likelihood of you finding 5 deals all at the same time? The likelihood of that is fairly low. So you're probably not going to find 5 deals. So there's going to be an opportunity cost while you're waiting to do your deals. So again, this goes back to that pipeline thing. If you've only got 60k and you can find a 50k house for cash, and you've took your 7-8 months to find a deal, then you might say, do you know what, I'm going to put the cash into there because I'm not really falling over deals, and I'd rather it in there getting 100% on my money, like in my rental income with no mortgage. But the reason I go for mortgages most of the time is because if you could buy 2 mortgages with this, and you say, for example, these give you, I hope you can see this okay, and it's getting a little tiny bit messy, these properties give you on average £500 a month. So you're going to have £500 a month if you buy a deal. That's it coming in. But if you buy 2 deals out of that, you've got that times 2. So you've got 1k a month. So even though you've got a mortgage on these, say these mortgages on these lower value ones are 150 each, you've got £700 a month as opposed to £500 a month coming in. So you are better off using leverage. But that said, if you can't find deals quick enough, there's no point in leaving 30k left in the bank. You might put your money into it. You can always, if you do stumble across another deal, there is always, you can always potentially use this equity in this house to bridge against it. So you can use the equity in here to bridge to buy the new one. It's going to be quite expensive, but if the deal's good enough, then it's worth doing. So it doesn't leave you no options until you refinance your money, but it's going to be a bit more expensive options. But in general, again, it goes back to the pipeline of deals you're getting. If you're not getting a pipeline of deals, then if you've got a decent pipeline of deals, do them both on the mortgage, I'd say. But when you've got 150k, you're not going to find 5 deals at the same time. Also, even if you did, to have the right network of builders and the organisation and the skills to navigate 5 refurbs at the same time is probably not advisable for most people as well, unless you really got momentum. So what is a good scenario when you got 150k is, let's say you buy your first one for 70k cash, then you buy your next 2 for 60k, like using 30k mortgages. But you could buy your first one on, say, on month 1. The next one on month 3, especially if you're starting out and you just want to get a bit of practice, get going, get some momentum. The next one on month 6. Never happens this linear, by the way, but this gives you a kind of idea. So then by the time you get to month 9 over here, you're going to refinance this first one what you've paid cash for, and then you're going to be able to buy roughly another 2. You'd probably leave a little bit in that deal, but by the time you get to there, you're going to refinance this one, and you can keep going and going this way. So this is how you fund your deals and multiple keep going if you've got a bit of a larger pot. But as I said, if you've got lower pots, you've just got to be a bit more creative. You've got to be compounding. You've got to save a little bit more and be a little tiny bit more patient. But the myth of a mortgage, not being able to do BRRR on a mortgage, is an absolute myth. It really bugs me when people say this, especially brokers, because brokers get double fees. They get a lot more money from brokers, get fees from you. They charge you a fee. Most brokers will charge a bigger fee for a bridging arrangement loan than they will for a standard buy-to-let mortgage loan. Also, brokers get fees from the lenders, typically anything from £1,000 up per deal. So they get more money also for these bridging than they do for mortgages. But if they get you on a bridge, then you're going to pay them the fees for the bridge. So this is where all these fees add up. So let's say your mortgage broker fees was £500. So you pay that once for the broker fee for the bridge, or you might pay £600 for the bridge and then £500 to then take it off the bridge and put it onto your mortgage. So your interest of £1,100 fees straight away. Then you've got to pay the solicitor twice. And if you get a bank that you have to pay, like in a limited company, their legal fees as well, it can really start chunking in to your fees. So this is why I don't go for bridging straight away, but sometimes I do go for bridging when I said in this scenario, when I've got a decent supply of money, decent supply of deals, and speed's more important and I'm compounding that income. Like this case now, if I've got a good supply of money, I might use a bridge a bit more, especially if I've got lots of deals coming in, because I'm like, okay, this is turning around really quickly because the income I'm going to be generating is really going to catch up with the money and the extra fees and compound that. So hope that makes sense. Please, if you've got any questions, put them in the comments. Love to hear how you fund your deals. I hope that's debunked that myth around being able to use mortgages. If you want to learn more about the BRRR strategy, I do a workshop called How to Invest in BRRR Property Remotely and Live on Your Terms. And our BRRR, remote property investing, is investing in the North East. This is where you'll still pick up these style houses, which gives you fantastic returns. I live in the South and I invest in the North. But whether you live in the North or your South, this BRRR, on this workshop, we'll be showing you how to find your areas, find the deals, show you how to fund them deals, and also show you how to manage the refurbs. The three major things that people get stuck on with the BRRR strategy. So whether you're doing it remotely or locally, this workshop's going to have a ton of value on there for you. There's going to be no selling, no upsells on this. You don't need your credit card. It's just going to be a ton of value. So join me on my next up and coming workshop. The link's going to be in the comments. And listen, if you're still here now, please smash that like button, hit that subscribe button, the bell icon, so you get notified when we record more videos like this. We're putting out 2 videos like this every single week now. My wife's living my terms. My mission is to help as many people live on their terms, using property as a vehicle to do that. So please share this out there to as many people who you think get value from that. And remember, if you don't evolve your ideas, you're never going to live on your own terms. So evolve your ideas, live on your own terms, and have an amazing day.